My name is Garrett Taylor, President and CEO of Advisor Successions. We are a firm that specializes in helping financial advisors buy and sell practices across the country. Today what we're going to be speaking about is succession planning and the keys to selling your financial advisory practice. Some of the things we're going to think about today are, what is your transition timeline? What is the view of the current advisor landscape? Is your practice the largest investment that you have? The benefits of proper succession planning. How do you identify a successor if you don't already have one? Some of the pitfalls in structuring deals, and a number of other topics that are pertinent to the succession planning topic, as it is a hot topic today. First question I'd have is, what is the average age of a financial advisor today? And as you can see, as studies show, the average age for financial advisors is somewhere between the ages of 53 and 55, with over 20% of the population greater than the age of 60. The problem with that is that 70% or more, and in some cases, some studies will say as high as 90% of those, don't have a formal succession plan in place. Couple that with fewer financial advisors entering the workforce because of 2008, as well as some of the big firms not hiring new advisors and college kids coming out to enter into the workforce. The problem is that there aren't as many financial advisors out there who are willing and able to acquire your practice and act as your succession plan. So if this is something that's 0 to 10 years away for you, you want to start to think about positioning yourself in a way of strength as opposed to looking at something at the last minute. And because the practice could be a very big portion of your net worth, you want to make sure that you do your due diligence in this process. Many financial advisors will see that their practice is comprised of about 70% or more of their net worth, followed by their individual investments in home equity. And as you insure your investments and some of your equity in your home through various types of insurances, you also want to think about doing the same to your financial advisory practice. And you can do that very simply through succession planning. And succession planning doesn't mean that you have to sell your business today. What it means is that you set up some structures in place and you communicate to your clients the opportunity there that if God forbid something were to happen to you, that they'll be taken care of. And the real value in your practice is the relationship that you have with your clients. So what we want to think about is how do we ensure that those relationships can be passed on to the next person who is going to ultimately carry the torch for you. And in setting up a succession plan, that's exactly what you're doing. And this can be accomplished by a simple document and setting that up both with your broker-dealer and at the firm level, as well as communicating that with the clients. Stating as such, God forbid clients, if something were to happen to me, we're able to protect your practice and protect your best interest as clients, and so advisor is going to be there to take care of you. So as you can imagine, succession planning is a really important tool to protect the value of your practice. It provides for an efficient transfer of the assets as well as the clients. It looks at the control of the timing. So I'm sure many of you have experienced other financial advisors out there who unfortunately have had some type of illness or even a death that created them to have to do a fire sale within their business. And as you know, the value of a fire sale is significantly reduced. The assets usually do not transfer in a timely manner, and the relationships are often lost. So by simply setting up a succession plan, you can avoid all of those potential pitfalls. It does help also if, in fact, you're looking to minimize tax implications, which we'll talk a little bit more about. And it's very important for the continuity of service from the client experience. So first thing we want to think about in succession planning is, what are your needs? What are the needs that you have as a financial advisor? And ultimately, what is your timing? Are you someone that's looking to hang up your hat within the next 6 months? Or is this something that may be 5 to 10 years down the line? We at Advisor Successions believe that as long as you're within a 10-year time horizon of retirement, we can absolutely help you determine what the best succession plan should be for you. What we're able to help with is how to decide on the approach, and ultimately, how do you identify a buyer? As I mentioned, because there are fewer advisors entering the workforce, there are fewer opportunities to find that successor, that person that will be the buyer of your practice. And as the advisor population ages, that number will continue to dwindle. We'll also be able to help you consummate the transaction and looking at ways to structure a deal that's beneficial for you as the seller. Because right now as the seller, you're still in the driver's seat. So when you think about succession planning, you're the one that's in control. You're the one that's able to help yourself and put something in place where if you're far enough in advance, you'll be able to set up something with a buyer out there who is ready to meet your needs and help you potentially slow down or ultimately retire for good. So one of the things that we look at in interviewing financial advisors who are looking to sell their practice or potentially retire is what's going on in their situation that's created this need. The first and foremost, the biggest reason why advisors have sold their practice over the last few years here that we've seen is that they've burnt out. You know, the industry has changed significantly. What was once a great way to build a business is no longer there. Compliance is constantly an issue for financial advisors. Expenses are going up, revenues are going down, and margins are shrinking. So as we look at those independent silo type advisors out there, we're finding it harder and harder to compete and remain profitable. So that burnout was also accelerated by the 2008 activities in the marketplace. Other advisors are looking to slow down. So working 40, 50, 60 hours a week for many, many years often creates the need for many advisors to say, hey, well, listen, can I take a step back from my practice and slow down? There are many ways to do that, both internally and externally within your broker-dealer or within your firm. Many advisors are also looking to retire. You know, we see the average age of retirement for a financial advisor is in between the ages of 66 and 67. Other advisors are looking for a liquidity event. The market is at all-time highs. They're looking to potentially monetize their practice because if you have a fee-based practice, your revenues have never been any higher, especially if you have a growing business. So now might be the time to look to monetize that practice. Fewer advisors are looking for a career change or just a change ultimately in what they're doing with their lives and maybe have other aspirations for the future. There can be some unfortunate, unexpected events as well as just looking at creating a longer-term exit strategy. So the first thing in succession planning for yourself is that ultimately you need to decide on the timing. Are you looking at retiring immediately or selling your business immediately? In our opinion, this is not the best way to do it because, as I mentioned earlier, you're really transitioning relationships. And we at Advisor Successions feel that in order to successfully transition a business and transfer those relationships, there should be at least 3 meetings between the person who is selling the business and the new buyer along with the client. So that should be something that consummates over the course of, in our opinion, 12 to 18 months. Maybe you're a buyer that's 6 to 12 months, which is slightly better. 12 to 18 months, as I mentioned, is ideal. And then looking further from that 5 to 10 year standpoint is really where you can create some extra value in your practice, extra value in your business, and really make sure that you have very high retention in the transition of that practice. And then other advisors are looking for contingency only, which would be something similar to a buy-sell agreement. And again, to recall what I talked about earlier, 70% or more of financial advisors do not have just the basic document of a succession plan in place. So if you take anything away from this discussion today, definitely look at what you have within yourself. If you don't have anything, don't worry, you're not alone. If you're looking for the opportunity on what to do, feel free to contact us, and we're happy to help you with that process and set you up along the way. So once we've decided on the timing, what's the approach that ultimately we're looking to sell this practice? So the first opportunity is the outright sale. So in the outright sale, you have 2 distinct ways that you can do this. Internal, if you're with a broker-dealer, or if you're an RIA that has someone internally within your own firm that's willing to buy. Or externally, selling to outside source, another broker-dealer, RIA, investment advisor, or whatever have you. So in our experience, what we've seen is that many of the external deals will garner an additional premium because it's new assets to the new firm. Often we're able to see some bank financing as well through that, which we'll talk a little bit more here in a few minutes. Another opportunity is a partial sale. So as I mentioned prior, many advisors are looking to potentially slow down in their practice. And a great way to accomplish that is to monetize the lower portion of your client base. So if you categorize your clients as A, B, C, or D, we've seen many advisors sell their B, C, and D clients and only continue to work with the A's. That obviously would then free up your time, still allow you to generate revenue off your practice, but be able to call out some of the labor-intensive relationships that you have. Other advisors will look to team up. If you're in that 5 to 10 year time horizon, it's a great opportunity to merge with another practice that's done this before, that's successful, that can provide some extra value for your clients. The other thing that comes to bat with a merger is the fact that that particular firm might have additional staff and resources that can help to take some of the paperwork and the administrative work off the plate that obviously has bogged many of the advisors down over the course of the last few years. That opportunity, you can team up within an advisor inside of your own broker-dealer, or you can look at changing broker-dealers. And one of the things to think about in changing broker-dealers, especially if you're in that 5 to 10 year time horizon, is the opportunity to monetize your business twice. Many firms out there are paying significant multiples on revenue of your practice to join them, and then they're also paying advisors on the way out. So that's a way, if you're 7 to 10 years from retirement, to capitalize on your business today and the all-time market highs, but also find someone and create a long-lasting relationship and merger with a potential partner, and then ultimately sell the business again on the way out. Your other option in succession planning is training a successor. So one of the things that we found in that looking at training a successor is that many advisors are great advisors but not great managers. So what we found is that they're not able to train those financial advisors who are either coming out of college or in that 0 to 5 year time horizon and coming into the practice. Oftentimes you'll see this with a relative, a son or a daughter looking to take over the practice, and many times, more so than not, unfortunately, we see this as a failed opportunity, as a failed experiment within your practice. And the problem with that is that's a lot of time and resources and a lot of introduction to your clients of this new potential advisor that could ultimately take over your practice. And when that doesn't work out, many times it's confusing from a communication standpoint to the clients. And many advisors don't want to spend the time to train a new advisor because, as you know, if you've tried it before, there is a lot of work in getting an advisor to a client-ready status. So one of the things that we've seen in training a successor is advisors who want to bring in a junior are often looking for financial advisors that have experience in that 5 to 10 year arena. Many of those advisors are working at wirehouses or banks and are open to the opportunity of joining a larger practice to come in and essentially continue to run your firm over the course of a period of time. This process traditionally works best for advisors that are at least 5 years from retirement because it gives you a really good chance to solidify the relationship with your clients. So what's the next step? After we've decided on the timing and the approach, the next thing is to really identify a qualified buyer or successor. And how do we go about doing that? So the first thing that we recommend at Advisor Successions is for you to find someone out there that's compatible. The number one reason why a financial advisor will sell their practice to another individual is because they're the right fit. And we found that this oftentimes is a very difficult task in finding that particular buyer because they might not have the same value proposition that you have. So as a seller, you want to really make sure that you do your due diligence because your clients have grown accustomed to liking the way that you do things. So if you're going to be selling your business, you want to make sure that at the very least they're doing a similar type of service from a client service model perspective, and if at all possible, they're able to enhance your relationship, able to create efficiencies within your practice, able to add other financial professionals that they might have within their firm to really just increase the overall client experience. The next thing we want to look for in a qualified buyer is, are they experienced and seasoned? You never really want to be a guinea pig for a prospective buyer, meaning you don't want to be the first person that they've bought or the first person that they've done a succession planning for. And the reason for that is because as you think about it, you're running your practice today, they're also running a practice. If they don't have the systems and structures in place to acquire your business, the retention ultimately will fail, the client experience will suffer, and the overall value to you as a seller could suffer as well. So you really want to make sure that they have the systems and structure in place to take on another 100, 200, or 300 clients, depending on the size of your business, and that they have the ultimate bandwidth to make that happen. You want to make sure that the buyer has similar values in the client service model. Again, we'll talk about that, which is really important, is if you're seeing your clients face-to-face 4 times a year, you want to make sure that that buyer has something similar in place or has a way to meet the needs of the clients if that's what they've grown to expect. Another important part in a qualified buyer situation is that you want to make sure that they're financially capable. Many financial advisors out there who are very successful financial advisors often are not financially capable to buy another practice. So you as a seller have the right to go and ask the buyer to prove that they are financially stable enough to acquire your business, and what portion is going to be coming from their own funds as well as what might be coming from a bank. Increasingly, we're seeing bank financing come to the plate more and more with organizations like Live Oak Bank who will go out and provide the financing. And why we like that structure is because you as a seller are protected by the bank, and the bank is the one that's holding the note to the buyer, not you as the seller. So there creates some tax efficiencies there for you as well as some security, knowing that an SBA lender is actually the one that's giving you the funds. The next thing is geography. Where is the buyer located? Are they located in your geographic territory, or are they located somewhere else throughout the country? If they're located throughout the country, do they have a service model where they're able to run a satellite office effectively and deliver the client experience? So if it's someone that's remote, you want to make sure that you're doing your due diligence as well there to make sure that they will continue to service the clients the way that you have, and also make sure that those relationships continue to run smoothly. Again, paramount in this decision is finding someone that is compatible to you, because working with someone that is compatible often creates a great situation and some increased revenue, as opposed to someone who's not the right fit, who ultimately will create some pain and suffering. So now that we found that compatible advisor and the right fit, how do we consummate the transaction? The first step is to come up with what the terms are. How do we structure the deal? How much is down? How much is financed? Who's paying for what? And what are the overall expectations of the deal? Next step is to do the due diligence on the practice. Are these practices compatible from a broker-dealer standpoint, a product service standpoint? Are there non-competes involved? These are all things that you really need to understand in that due diligence process. Next is to come up with the paperwork. We at Advisor Successions provide all paperwork for all advisors that we work with, both buy and sell side. So we're able to help with that. And oftentimes we'll recommend attorneys in local areas if in fact you feel like you might need some additional resources or counsel. The next opportunity is to look at how do we close the transaction and what is the timing. And then lastly is we begin the transition. The transition, as I mentioned before, from a transition standpoint, really looks at somewhere in that 0 to 3 month time frame to transition all assets from one broker-dealer to the other. And then to solidify the relationship, we like to see advisors involved for a minimum of 12 months, if not 18 months if possible. Again, we feel that 3 client meetings with both buyer and seller present in the meeting will help to solidify that relationship, create the lasting bond for the relationship to be passed, and create the retention that you need to ultimately get the full value for your practice. So what are some of the things that you can do today from a practice valuation standpoint to drive that value? First, something that you can't really fix in that situation is where you're located. Location of a practice is extremely important. Location, location, location. If you're in a heavily populated area with thousands of financial advisors in a place such as Manhattan, the multiple for your practice will be driven up substantially. The reason that is that's competition and it's free market there, so there are more buyers for your practice. Next is looking at how is your revenue derived. Those practices that have fee-based revenue and fee-based asset management often have a higher value than those that are transactional. What are your client demographics? Meaning, do you have mostly younger clients or mostly older clients? Those businesses that have average client ages in their late 40s, early 50s are much more valuable than those that are in their late 70s, early 80s. Is your practice in net inflows or net outflows? Meaning, are you taking on new assets or are you losing assets through distribution? What is the size of your practice? Many firms require higher multiples as they get larger. So your $1 million plus revenue type firms will get a higher multiple than those that are $400,000 or $500,000. And vice versa, those smaller practices that are $200,000 or $250,000 that have a small client base oftentimes will have a higher multiple as well. So that creates a bell curve type scenario. So we want to look at what's the real value to your practice and how can you set it up in a way that's going to be a win for you. What is the portability of your client base? So we want to look at what are the products and services that you're offering. Do you have a standard financial planning business where you're selling mutual funds, stocks, bonds, and equities? Or do you have more of a complex business, selling alternatives, annuities, things like that? We want to look at, from that perspective, do you have proprietary products as well? So some of the larger broker-dealers and firms out there will offer only proprietary products that are not able to transfer. So what is your business made up of, and is there a way to set it up in a way that you make sure that it is securing the value for yourself? What is the client tenure? So do you have clients that have been on with you for 10, 20, or 30 years? Or do you have mostly new clients? That's very important. Do you have client acquisition? Are you taking on clients every year, or are you losing clients? It's also something to think about in your practice. And then lastly is retention. What is that retention of assets? What is that retention of ultimate number of clients? And are you, again, solidifying the value of that practice? And what is the goodwill that you have there? And how willing are you to transition that relationship? The more willing the seller is to participate and to pass the relationship from seller to buyer, the higher value you'll get and the more happy you'll have as a buyer and the more happy situation you'll have as a seller. So what are the typical multiples for your practice in the financial services industry today? So first we want to look at recurring revenue. Recurring revenue would be fee-based assets, trails, whether it be from mutual funds or L-share type annuities, or any types of trails that are coming in from direct business and the like. So the current marketplace dictates that, and what we're looking at from a revenue perspective is somewhere in the neighborhood of 2 to 2.5 times recurring revenue. You'll see multiples of 3 and higher for those practices that are $1 million in gross revenue and more, and you'll see slightly less for those practices that are on the smaller side that are mostly commission-based. As you look at the commission-based revenue, those that would be transactional type sales, if you will, first would be A-share type mutual funds, upfront annuities, stock trades, bond trades. Those practices are valued usually at 1 to 1.5 times that particular revenue. Again, as your practices get larger, there are often measures of free cash flow, which we can discuss at another time. So what does a typical deal look like? So the average deal will usually see a component that consists of a down payment and then often a term that's financed by the seller. So what a typical down payment, cash down payment, will look like is somewhere in the neighborhood of 10 to 50% down, with the rest of the note financed over the course of 3 to 7 years at an interest rate that usually winds up in today's interest rate somewhere around 5 to 6%, and you as the seller will hold that note. What's become more and more apparent in these last few years here as bank lending has started to free up slightly is that we're seeing companies come in that specialize specifically in financial advisor lending. There's a company out there, as I mentioned earlier, called Live Oak Bank that focuses on this lending that will help the financial advisor purchase the practice and really secure you as the seller. Again, that bank would write the check to you for the value of your practice, and then the buyer would pay the bank back over a period of time. So why that's important to you as a seller is because your payment would be secured. It's a lot more secure to get a check from a bank as opposed to a check from John Doe Financial Advisors' local checking account. So that's something to think about as well. There's also opportunity for an earnout, which is rare. Usually you'll see that in situations where the advisor will stay on for a period of 2 to 3 years and really will help to generate more value in the practice. So that's something to think about as well, is if you're longer term, you still could transition your business to another firm and then create additional value for yourself by extra hard work. What are basic ways to provide additional value within your practice? Again, as I mentioned, fee-based is king. You want to look at calling out smaller relationships. So if you have a practice that has 500 clients, it's often difficult for a financial advisor to buy a practice that large. So what you want to think about is, are there some relationships that you could sell internally or to someone else to almost window dress your practice? You want to focus on expanding the average household size of assets, whether it be $250,000, $500,000, or $1 million, depending on the size of your practice. And then also looking at depersonalizing the business. So many advisors out there use their last name and associates and sons as the name of their practice, or even just their full name as the name of the practice. It's often difficult for Mr. Taylor to buy Mr. Smith and Sons practice and continue to run that practice with that last name. So oftentimes we've seen advisors run practices with just simple names. Something to think about also if you're in that 0 to 10 year time horizon. And a lot of times we'll see that come together with the use of a merger. So let's look at a practice valuation example. So let's take a typical advisor who has somewhere in the neighborhood of $25 million in assets under management and $300,000 in gross revenue. This particular practice is generating $250,000 in recurring revenue and $50,000 in transactional. In this situation, the advisor had clients that were somewhat on the older side, so we used a recurring revenue multiple of 2 times recurring. So 2 times 250,000 gave us 500,000 for the value of the recurring revenue, and then 1 times the transactional revenue of 50,000, which gave us 50,000. So for a total value we looked at in this particular practice was 550,000. Again, obviously this is only a representation of a typical deal. Every practice is structured different, and all those different factors we discussed earlier will help to drive revenue within that practice and value. But this is something just for illustrative purposes that really just gives you a sense of what the practice looks like and what it could ultimately be worth. So in this deal, just to take it a step further, we talked about how a deal is structured. There's a down payment component as well as a finance section of this. So in this scenario, what we were able to do is 30% down on the 550,000 gave us 165,000, and then there was a 5-year deal at a 5% note, which gave us $85,000 per year of approximate cash flow. At the end, when this deal was paid off, the total value to the seller was $590,000 with interest. So what we want to think about too when selling a practice is that outside of that first year, you really want to think about what your cash flow is. And also as a seller, you have a way to dictate the way that a deal is done. So some of the sellers that we work with want more money for cash up front to finance a vacation home or some trips and extravagant things they want to do early in their retirement. Others would rather create a longer, say 10-year type of deal to create a pension for themselves, to carry them either through Social Security or just have that extra income around. Again, as a seller, you're in the driver's seat, so you really want to think about your own financial situation and what you need personally from a cash flow perspective, and then structure a deal around that way. Most buyers that you'll work with that are compatible, that really think they are a good fit for your practice, will be more than happy to be flexible in this deal. Now that you've determined the value of your practice, you've found a buyer, you've thought about what your transition looks like, let's talk about some of the things that you might not be thinking about. So some of the pre-closing matters, if you will. So the first thing to think about would really be, what are the tax implications of the proposed deal? How much of this deal is set up as capital gains versus ordinary income and goodwill? And is that something that's advantageous to you? The majority of the deals that we'll do will see a significant portion of the total practice price as capital gains to the seller. So this means that oftentimes the practice sale is advantageous to you as a seller. So that's something to think about. The other thing to think about is if you're working for a broker-dealer, do you have a non-compete or non-solicitation there? A lot of firms out there have sneaky ways, so to speak, of having these types of documents signed earlier in your career, and if you've been there for 25 or 30 years, you may not realize that you have that. More times than not, there is not a non-compete, and more times than not, we're seeing broker-dealers part of the broker protocol, which allows firms to transfer from one firm to the other without lawsuit. But this is something that you want to really be aware of, because if in fact you have a non-compete or non-solicitation, that will limit your buyer pool. Meaning, if you have a non-compete, you're probably going to want to sell to another financial advisor that's within your own organization. Next is really knowing the expectations for yourself as a seller and for the buyer. What is it that's required of you once the deal is done? What are you supposed to be doing? Are you coming in 9 to 5 like usual, or are you just coming in to meet with clients on an occasional basis? Really spell out the expectations of the process with you and the buyer up front before you get into a deal and commit yourself to a situation that you were unaware of. The other thing that's really important, and extremely important I should say, is the positioning of this to the clients. So the clients will know that something is going on. Whether it's a merger or a straight retirement, you really need to get out in front of this and tell the clients exactly what's happening. Positioning it as a merger is a great way to do this in the beginning, but if in fact you will be retiring in that 6 to 12 month time horizon, you want to let them know that ultimately the buyer is going to be the successor for you. and that you've handpicked that relationship after vetting out a number of different buyers and felt that they were the most compatible and the best fit for you, Mr. Client or Mrs. Client. Some of the things to think about post-closing is, really what is your mindset? How are you introducing the buyer to your clients? And what is the process that you're following there? This is really important when you're finding the buyer, as I mentioned earlier, and someone that's done this before. If you find a buyer that's done this before, they know the process and they know what works. And they'll be able to hold your hand, so to speak, in a way to lead you down that path to figure out which clients you need to meet with right away and which clients can be communicated over time. This is extremely important because most of these deals, as you know, are tied to some type of retention. So if you have very high retention, 90 to 95%, you'll see great value in your practice. If you see lower than 70% retention, oftentimes the deals are reduced. So understanding that transition process and that introduction process of buyer to client with you facilitating that process will really help solidify the value in your practice. And as you can imagine, a weak execution in this deal will only hurt you, the buyer, and the client relationship and client experience. So understanding fully and working together is important. And in those coming weeks up until the closing of the deal, you want to make sure that you have a game plan lined out and strategize so that it will work and that it's not all done by fly-of-the-night type of arrangement. So here are some of the common mistakes that we've seen in dealing with sellers. Many advisors are looking to do this themselves. So the problem we've seen there is that a lot of times the sellers don't have a really good understanding of what their practice is worth. If you don't have a good idea of what your practice is worth, it's often difficult to sell it for market value. Another issue with selling it yourself is that if you've been doing this for 20, 30, 40, or even 50 years, you're emotionally invested in your practice. Blood, sweat, and tears to grow this business. You're very proud of it in most cases, and oftentimes you're not willing to sell it for realistic expectation. So it's oftentimes very difficult to get the optimal deal because of some of the different roadblocks and speed bumps that will come up along the way. Another area of mistake that we've seen is selling to a colleague or to a friend. What we've seen as an issue there is that you don't always get the best deal, and many times you don't see a lot of compensation from an upfront perspective. And God forbid there's some market fluctuations and some market downturns. A lot of times it's easier for a friend to say, hey, well, listen, can I pay you next month? And in many times we've seen sellers go through this situation where even though they had a contract, they've been lenient on their friends and relatives or colleagues, and often have had experiences where they've had to go to court to sue for the remaining value of their practice. And as you know how expensive that might be, that will often dwindle the value that you have there. Another big issue that we've seen that we stressed earlier is that the sellers don't qualify the buyers. It's really important to understand the financial situation, the cash flow, personal assets, and net worth of the buyers that you're exploring, in the sense that you want to make sure that they have enough free cash as well as enough net worth to supplement the practice and to buy that practice and provide the down payment. And if it's not on them, are they using a bank or a broker-dealer? In that situation, obviously you have a little bit more flexibility and freedom because often the banks will give you certified funds, and it's a lot easier to understand where those funds will be coming from. So in our opinion, using a bank, using a broker-dealer assistance program would often be the best way to fund these types of transactions. So what's the best way to go about finding a potential buyer? So in our opinion, there's two options. The first option is the market-based approach, where ultimately you put out your practice on a website or a server which will list your practice, and there'll be a multitude of bidders. There's a lot of marketplaces out there. There's a lot of competitors out there that will offer this service. They post your practice out on a Craigslist type listing, and then you'll find a particular buyer that way. The one problem we found with that is that it's not very personal to do this, as well as you'll see some issues with just some privacy matters. So more and more sellers are coming to us to look for other options in this marketplace. What's one good thing about that is that it will drive competition and could potentially drive the value of your practice to over market value. But many sellers would rather not have to interview 5, 6, 10 firms. They'd really rather be introduced to someone that's qualified that they know will be the right fit. That's where using someone like ourselves, Advisor Successions, as a third-party advisor can really help to smooth that process and that transition and really make it a great experience for all parties involved. The benefits of working with a third-party advisor would be really figuring out what the objective and strategy is. So you as a seller, as we talked about, should have that objective. What's your time frame? What are the deal terms? What are the different things that you're looking for? We can help to really solidify that process. We can look at a potential value for you. So Advisor Successions provides complimentary valuations to sellers to give you a sense of a range of what your practice is worth. We then help to identify and screen appropriate buyers. We have a stable of financial advisors across the country who have been financially vetted, screened for compliance purposes, as well as just overall client service model. And we're able to introduce you to those folks and people that have done this before and that really know what they're doing, that really create a great experience for you as the seller. We can give you guidance on that deal structure. We assist with the process. And obviously, as we mentioned earlier, we remove the guesswork by providing all of the paperwork and really acting as that liaison. And for many of you, this is your first transaction in selling your practice, and we've done this thousands of times and helped to really smooth out that process and eliminate all the speed bumps and roadblocks that might come up throughout the negotiation scenario. So that's really where we think a third-party advisor adds tremendous value and support, and we really want to make sure that these deals get done effectively and that it's a great experience for all parties involved. So as we mentioned, Advisor Successions is a firm that specializes in helping buyers and sellers across the country, and we really do hope that you found some extreme value in this presentation and we're able to get some key takeaways that as you take this back and look at your own practice, you can really help to implement those and look at really creating a solid succession plan and a win-win for both you, the seller, and the buyer as well. So we'll pause for a minute to take questions. And again, thank you so much for taking the time today. And we look forward to the opportunity of speaking with you